Welcome to the deep dive. So the stock market's definitely been keeping us on our toes lately.
Yeah.
And judging by the messages we've been getting, you're just as interested as we are in figuring out what's really driving these shifts. A lot of you are asking specifically about interest rates and how they connect to the market going up and down.
That's right. And look, it can seem pretty complex, all these macroeconomic concepts,
Mm.
but actually understanding how interest rates impact the stock market. It boils down to some core economic ideas.
Hmm.
So our goal today is really to, break this down. We're using that analysis you shared, the Oktat Shrivastava video, as a kind of guidepost. We want to get beyond just the headlines.
Absolutely. Aiming for that moment where it just clicks. Okay, so let's jump in. Interest rates, I hear the term all the time. But when we're talking stock market impact, what specific rate are we actually focusing on?
Yeah, good question. The key one here really is the repo rate. So, simply put, that's the rate the Reserve Bank of India, the RBI, charges when it lends money to the commercial banks. Think HDFC, ICICI, those guys. It's like their base cost for borrowing money.
Right, right. So the RBI lends to the big banks, let's say, I don't know, at 3%.
Yeah, for example.
Then those banks, obviously, they need to make a profit when they lend that money out to us, right? For things like home loans, car loans, or even the interest you get on a fixed deposit. Maybe that ends up around 4% in this example.
Exactly. So that rate you get or pay, it's directly influenced by that starting repo rate.
Okay.
And what's really powerful here is the ripple effect. Just by changing that one rate, the repo rate, the RBI can basically nudge interest rates across the entire economy. It's a big lever they can pull.
A big lever. Okay, so the RBI pulls the lever, tweaks the repo rate. How does
Yeah.
that actually make the stock market jump or fall?
Well, the thing about the stock market is it's always trying to look ahead.
Forward looking, right.
Exactly. Investors, traders, they're constantly trying to guess what's coming next for the economy. We saw a really clear example of this back in September in the U.S.
Mm-hmm.
Between, I think it was the 12th and the 21st, the market took a noticeable dip. And the main chatter, it was all speculation that the Federal Reserve, the U.S. Central Bank, was about to hike its main interest rate.
And that chatter turned out to be right on the money, didn't it? September 22nd, boom, the Fed announces a pretty hefty 0.75% hike.
Yep.
It almost felt like the market had already sort of processed it beforehand.
Precisely. It had braced itself.
Yeah.
And we're seeing something, kind of similar playing out in India right now. There's this general expectation that the RBI is going to announce a rate hike soon, probably around 0.5%, 0.5%.
Right.
And, well, we've already seen the market trend downwards a bit in response.
Okay.
It's almost like the market saying, okay, we think we know what you're going to do, so we're adjusting now.
That makes total sense. It's pricing in the expectation. So, okay, let's talk about different ways this can play out. How does the market typically react depending on, how the rate change happens?
Yeah, that's really key to understanding the psychology. So let's walk through a few scenarios. Scenario one,
Yep.
imagine the RBI or the Fed just drops a rate hike completely out of the blue. Nobody saw it coming.
Total surprise.
Total surprise. In that case, the market would likely react pretty badly, probably a sharp drop. Why? Because it introduces uncertainty, and markets really, really hate uncertainty. Big surprises are not welcome.
Got it. No one likes that kind of surprise party for their portfolio.
Mm.
Okay, what about the second scenario the hike is expected? Like the one we're sort of anticipating now from the RBI.
Okay, so if the actual hike comes in exactly as expected,
Mm.
let's say everyone's priced in 0.5%, and the RBI does exactly 0.5%, then the market reaction will probably be pretty muted. Minimal impact.
If it's already baked in.
It's already baked in. But what if the central bank is a bit more aggressive than people thought? Say the expectation was 0.5%, but they actually hike by 0.75%.
Ooh.
Then you might see a bit of a dip, a slight decline as investors think, okay, they're being a bit tougher on inflation than we anticipated.
Right, adjusting to that slightly more hawkish stance.
Exactly.
Okay, and the flip side, scenario 3. Everyone's braced for a hike, maybe even talking about 0.5%, and then the central bank does nothing. Or, even better, they cut the rate.
Now that is usually seen as good news for the market. If rates stay flat or go down when everyone expected them to go up, it signals, maybe borrowing conditions will stay easy or get easier. That tends to boost confidence, and you often see a market rally.
Okay, starting to get a clearer picture of the mechanics here. Rate changes move markets based on expectations.
Right.
But why are the central banks doing this in the first place? What's the big picture goal behind messing with interest rates?
The main driver, the term they use, is liquidity management.
Liquidity management. Okay.
Basically, managing how much cash, how much money, is readily available and sloshing around in the economy. Remember all that quantitative easing, especially in the U.S.?
Yeah, the whole money printing thing to stimulate the economy after crises.
Exactly. QE involved the central bank buying up assets, which effectively pumps money into the financial system, more money flowing around.
Right, injecting cash.
Precisely. Now, the potential downside of having a lot more money circulating is inflation. Think about it like this. Imagine everyone in your office suddenly got a huge pay raise overnight.
Okay, nice dream.
Huh, yeah. But what happens next?
Hmm,
Everyone has more money, so demand for everything, groceries, cars, holidays, you name it, we would probably shoot up.
makes sense.
But if the supply of those things, the number of cars being made or available vacation spots, doesn't increase just as fast, what happens to prices?
They go up. Too much money chasing too few goods. Inflation.
Bingo. That's inflation. And as the video pointed out, inflation, particularly in the U.S., has been, well, let's just say persistently high.
Yeah, very, very high was the phrase used, I think.
Right. So job number one, or at least a primary mandate, for central banks like the RBI and the Fed, is to keep inflation under control. And raising interest rates, specifically the repo rate, is one of their main tools to do that.
How does raising the repo rate help control inflation then?
Okay, so if the RBI raises the repo rate, it costs more for those commercial banks, like HDFC, to borrow from the RBI.
Right.
So what are they likely to do? They'll pass on those higher costs. They'll charge higher interest rates on the loans they give out to you, to me, to businesses.
Ah, okay. So suddenly getting a mortgage for a new house or a business loan to expand, it becomes more expensive.
Exactly. That higher cost of borrowing generally makes people and businesses think twice. It tends to cool down borrowing and spending across the economy. It effectively shrinks the money supply, or at least slows its growth.
Less borrowing, less spending.
Less money chasing the same amount of goods and services. And that, in theory, takes the pressure off prices. It helps bring inflation down.
Okay, that sounds logical. Raise rates, borrowing slows, inflation pools. But the video brought up this historical figure, Paul Volcker, suggesting it's maybe not always that simple or painless.
Ah, yes. Paul Volcker, definitely a key figure. He was the Fed chairman back in the late 70s, early 80s, and he was facing a monster of a problem. U.S. inflation was out of control, like 14–15%, double digits.
Wow, that's huge. So what did he do?
He took pretty drastic action. He implemented a series of really, really aggressive interest rate hikes, pushing them way up.
Did it work? Did it kill inflation?
It did, eventually. His shock therapy is credited with breaking the back of that high inflation. But, and this is the crucial but,
There's always a bet.
there's always a but, it came at a significant cost. Those super high interest rates choked off economic activity. The U.S. went into a recession, and it arguably led to almost a decade of pretty sluggish economic growth afterwards.
Yeah. Ouch. So yeah, inflation was tamed, but the economy paid a heavy price for it, which naturally makes people wonder now, with inflation high again.
Yeah.
Are central banks going down that same path? Could we see a Volcker-style slowdown?
That's the million-dollar question, isn't it?
Yeah.
It's easy to draw parallels. But the analysis in the video argues pretty strongly that today's situation, 2022 and onwards, is actually quite different from the Volcker era.
Okay, different how? What are the key differences?
Well, the video highlights a couple of main things. First, think about government priorities. Yes, central banks need to control inflation. But governments, whether it's the Biden administration or the Modi government, they have a huge focus on economic growth. Why? Elections, public approval.
Right, people don't tend to re-elect governments during deep recessions.
Exactly. So central banks aren't operating in a vacuum. There's this constant interplay, maybe even tension, between the central bank's inflation mandate and the government's need for growth. That dynamic is maybe more pronounced now.
Okay, so government priorities are one factor. What else?
The second big difference, according to the analysis, is maybe a shift in, well, societal tolerance for economic pain.
What do you mean by that?
Think about the generation that was dominant in the workforce and society back in the 70s and 80s. Many of them had lived through huge disruptions, the Great Depression, world wars. The argument is they might have had, a higher level of resilience, maybe a greater acceptance that sometimes you need tough medicine for long-term health, even if it hurts now.
And the video kind of contrasted that with today's expectations, right? Using the example of getting annoyed if our food delivery is like 10 minutes late.
Yeah, exactly. It's a simple analogy, but it makes the point. The suggestion is that society today has perhaps a lower tolerance for prolonged periods of economic stagnation or hardship. We expect things faster, solutions quicker.
And governments know this. They need to keep people reasonably happy, which means avoiding long stretches of low GDP growth if they possibly can.
Precisely. So that pressure from public expectation feeds back into the government's priorities we just talked about. It potentially makes them less willing to endure a Volcker-style protracted slowdown.
Interesting point. And there was a third reason mentioned about government control. This idea of don't bet against the Fed, but maybe amplified.
Yes, exactly. The argument here is that governments today, arguably, have much more direct control and influence over the economy than they did back in the 1970s.
How so?
Well, look at the increase in regulation across the board: banking, finance, non-banking financial companies, NBFCs, fintech, even gold investments in some places. The analysis suggests that through the interest rate mechanism plus this wider regulatory toolkit, governments can now manage the money supply and overall economic conditions much more tightly. Keep things humming along, keep the public reasonably content.
So the levers of control are just stronger now, more numerous.
That's the idea. Compared to the 70s, where maybe government control felt less absolute, the argument is that now they have near total control, primarily via interest rates, to fine-tune things.
Okay, so putting those three things together, government focus on growth, maybe lower public tolerance for pain, and greater government control.
The conclusion drawn in the analysis is that we're less likely to see a repeat of the extreme Volcker measures and the deep, prolonged downturn that followed. The expectation is for a more, let's say, managed economic path.
Right, which leads us directly to the stock market outlook. If we're not expecting a Volcker 2.0, what are we expecting for the market based on this analysis?
The general expectation presented is for the market to continue in a kind of long-term sideways trend. Think fluctuations, maybe broadly between the 17,200 and 18,400 levels for the Nifty, for example.
So not necessarily shooting straight up, but not crashing either, just range-bound.
Pretty much. And a key feature within that sideways movement is expected to be sector rotation.
Sector rotation. We've definitely seen that. Like banks have a good run, Bank Nifty hits a high, then maybe there's some profit booking, it dips.
Exactly. And then maybe money flows into IT or FMCG or mid caps or small caps for a while. This kind of churning, this rotation between different sectors and different types of stocks is expected to be the name of the game in this sideways market.
So the advice then is?
The suggestion from the source is to potentially look at buying the dips. When a sector that's done well pulls back because people are taking profits, that could be an opportunity, expecting that capital might rotate back into it later. It requires being a bit more nimble, perhaps.
Right, looking for those relative value opportunities as things cycle around. What about the extremes? A major crash, like a breakdown below that range, or a huge breakout above it?
The analysis kind of downplays the likelihood of a really major breakdown, so, something more than a 10–15% correction. The thinking is, given the current environment and the likely government response, a severe crash is less probable.
They'd step in somehow.
That's the underlying assumption, yes. A breakout, on the other hand, decisively getting above that, say, 18,200, 18,300 resistance level, is seen as more plausible. But the timing, that's the tricky part. Very uncertain.
The video did offer a bit of a guess on timing, didn't it? Something about the next 6 months, based on charts.
Yeah, it was termed a wild guess, I believe, suggesting maybe within the next 6 months. That was linked to looking at technical patterns, particularly in some big finance stocks. HDFC was mentioned as an example, a heavyweight stock that hasn't really participated much lately, but would likely need to perform for the Nifty to stage a significant breakout.
And I think you also teased a future deep dive on finding some of those potentially undervalued stocks in this kind of market. Definitely something for us and you listening to look forward to.
Absolutely. So I guess the main takeaway here is, yes, interest rates are incredibly important. They definitely influence the market, but the context really matters. Today's world with government priorities, societal expectations, the level of economic control seems quite different from past inflationary periods like the Volcker era.
Meaning, we might expect a more managed, perhaps less violently cyclical market.
That seems to be the core thesis from the source. Expect this sideways grind, this range-bound movement with lots of sector rotation happening underneath the surface. So the strategy might need to adapt to that reality.
Makes sense. A different environment might require a different approach.
Precisely. And maybe this leaves you with a final thought to chew on. If governments do have this much more control over the economy now, how does that fundamentally change things long term? Are those classic boom and bust cycles we read about in textbooks becoming a thing of the past? Is a more managed economy inherently more stable? Or does that very management introduce new kinds of risks, maybe unforeseen ones, down the road?
Hmm, that's a big question. Stability versus potential unintended consequences. Definitely something to think about.